In this video, I'm going to explain exactly how experienced real estate investors with perfect credit don't flinch at the high interest rates that hard money lenders are offering because they understand the simple concepts and they focus on the right numbers, and you can too. So I've explained in other videos that I like to think I'm a little bit unique in the fact that I've been on the ownership side, having done over 100 fix and flips, and I've been out shopping for hard money as a borrower. But now I've been in the hard money space for over a decade, and I've done hundreds of fix and flip and ground up residential transition loans, if you will. What I've gathered and really learned from some of my top borrowers is that you need a certain mindset, and you need to approach transactions, understanding the numbers, going out in search of the financing that fits the transaction. When you go in and you understand the mindset that I'm going to go through in this video, that will unlock your ability to maximize the returns on your investment. So I think one of the biggest mistakes I see in this space is that folks miss opportunity cost. And I'll explain what that means, right? So I believe, as I think most do, that you make your money on the buy. When you go and you buy a piece of real estate, or let's call it a single family house, and you have the inside track on it, it's off market, you know the market well, you know it's underpriced by the agent, one way or the other. When you buy it right, that fixes everything. That's, in my mind, where you lock in profit, or you at least lock in a nice cushion to somehow guarantee your profit, but you make money in the buy. What does that mean in terms of hard money? Well, hard money facilitates transactions that banks simply cannot. If you are looking to buy a property that's hot, it's priced low, it's an investor grade property, it's a foreclosure, it's off market, needs to be purchased quickly, that's where hard money comes in. Because if you just simply look at the fact that you either A, you need cash to be able to either put up an offer that's the seller's willing to accept or close in time, or B, you need to go to hard money paired with your cash to close. To me, the choice is simple. You either have the cash or you don't, and you go and you close it with hard money and you get it closed in time. And that's when you take advantage of the opportunity. You don't lose out on the opportunity. And to me, walking away from that transaction simply because you're shying away from the high interest rates is losing sight of the fact that you're able to buy this at a discount. You need to move quickly. You need to give an offer that's compelling to the seller, that gives them confidence that you can close. And that's when you come to an asset-based lending or a hard money lender, because we close without all the red tape. We always just close. And that's sometimes enough for folks to go hard money. It's the opportunity that's presented. It's the speed of money they need more than anything else. And the interest rates in certain cases are completely irrelevant. If I said, hey, listen, I'm going to sell you a property for $100,000 that's worth $200,000, and you are just fixated on our interest rate, which let's say is 10%, and you just can't get over it, or 12%. Well, the fact of the matter is you're just looking for quick money. You may not be in the deal for more than a month or two. Your interest carry is so low. The fact of the matter is you're looking to pick up $100,000 in equity the day that you close. So do interest rates really matter? What matters is closing on it. And ultimately, hard money, especially in the last 15 years, facilitates transactions like no other lending platform can. A traditional bank, credit union, any of those types of institutions, so much regulation on top of them that it prevents them from moving through the process fast. And ultimately, that's the niche that we fill here. We facilitate transactions, we get loans closed, and whether you're a perfect borrower with tons of experience or a first-time borrower looking to fund their first flip, hard money lenders are out there and we're closing. Sometimes that's all that matters. So before we go back into interest rates, I want to talk a little bit about origination fees, or points as they're sometimes referred to. Effectively, a point on a loan is 1% of the total loan amount. So in the example where we're coming in and we're going to fund, let's just say $180,000 loan, and we're going to fund $80,000 of the $100,000 purchase, and then we're going to put the $100,000 into escrow for construction. So the $180,000 loan amount, and we charge you a point, that's going to be $1,800 at closing. Now, that's a fixed charge. That's a fixed cost of doing the loan. You could have the loan out for 1 month, 6 months, 11 months, and you're paying that fixed cost at closing no matter what. So that should be a major focus of yours. You should ask your lender right up front, okay, what's my interest rate and what am I paying for points? You want to make sure that within the loan structure that the amount of points you're paying aren't exorbitant for the time that you expect to have the loan out. And most hard money lenders are out to make origination fees because they know that borrowers are going to be in and out of fix faster than they want. And so most of the profit that they're going to make are going to be in their upfront fees. I have the luxury here at ABL of offering both a rate and point structure where you could have a low rate, maybe of 9.5 or 8.99% and a point, versus going to a higher rate of 11.625 as an example, and no points. And we allow borrowers to play between the two programs to match their particular investment strategy and the time frame that they expect to pay or refinance us off. So the fact of the matter is as a borrower, you need to focus on your origination fees or the points that you're paying at closing, plus the interest carry, to make sure that the total cost of borrowing for that loan matches the strategy. You wouldn't want to pay an exorbitant amount of points on a loan that you only plan to have out for a few months, because effectively your entire cost of doing business with that lender is all in that upfront. With a group like asset-based lending as an example, you could pay no points at closing, save that cash, pay a higher interest rate, but you know that during the 3 or 4 months that you're going to have it out, that's a cheaper option than paying a lower interest rate and a point. Again, your focus should be on the numbers, looking at the cash flow and weighing the different components of a loan, which in this case is the origination fee, and deciding whether that loan matches this investment versus just blindly going out and accepting a low interest rate, paying more points or origination fees when it doesn't line up for the investment. You're certainly getting a low interest rate, but that doesn't matter for months and months if you're paying all those origination fees to close the loan. And by looking again at the total cost of borrowing and focusing on the math, you'll know which loan program is best for you. Investors need to focus on the time frame that they're operating in, right? So when you're coming to a hard money lender, you got a good opportunity. You need a renovation, you're doing a fix and flip. Maybe you're looking to get the foundation in and build a house quickly. The fact of the matter is you're coming to us for a fast moving, short-term 12-month loan. These loans are interest only, on balance. And so when you look at why you would use a hard money lender, you're coming to us inherently for speed. And it could be just speed to fund construction draws. It could be speed to close, whatever it is. You're looking to move through the project quickly, and our loan programs align with that. So how does that correspond to interest rates? Well, if we use a simple 12% interest rate and we say you're going to have to pay 1% on the loan balance per month, how long, Mr. Borrower, do you think, until you flip the property on the market? And the borrower will say 3 to 4 months. And I'll say, okay, well, that means that you'll effectively be paying 1% of interest per month. So you'll be paying 3 to 4 points of interest on the loan. So how do you feel about a 3 to 4% interest rate? And that concept blows their mind. But the fact is you're only using the money for a short period of time. It makes no sense for you to go out and get a 7.5% 30-year amortizing loan when you're paying most likely points. You're going through all that effort to get a loan, maybe even takes 60 days. And the fact of the matter is you could have closed and have renovated your property and be on the market before you could close a bank loan. When you put it in the context of time, when you look at it in the context of you're only planning to be in this property for so long, and you use our money for fast moving projects, and you break it down as to how much interest you're paying during the hold, you'll find that your focus will be less on interest rate and more on the actual cost to close and the speed in which the lender can close and fund construction draws. Then you're going to be focused on the actual interest rate charge, I promise you. So now we get a little bit advanced when it comes to interest rates. And I dabbled a little bit in the previous discussion about origination fees, but you really can and should drill down on your interest costs versus what you're paying in origination fees and look at the whole picture. Because I have a lot of people that come to me specifically in New England as an example, and they say, hey, I'm getting 12% and I'm paying 2 points for my loan. And I'm looking at it and I'm like, we have 11.625 and no points. So you're better to begin with, but why are you paying origination fees when you're only planning to be in and out of these loans for in 3 months? There's just no reason to pay that much money for your loan. My pros who have the option of taking rates in the 8s are opting for rates in the 11s and no points to bring less money to close. I know is important for everyone, but they're bringing less money to close and they're paying less closing costs and at the same time. And they're looking at the time frame that the loan is out and they're saying, okay, I'm only going to be paying this amount of interest. I'm very solid on my timelines. I know I can get through the renovation. I'm going to pay the higher interest rate all day long. Because when you look at the math, especially in our programs, there's always a break even, and you're always looking to say to yourself, okay, if I go and pay a higher interest rate in lieu of paying points and those fixed charges at closing, I can have this loan out at the higher interest rate for 7 or 8 months before the two situations break even. And you're constantly reverse engineering the math to make sure that you know what your cost of borrowing is. So I've had borrowers come to me, close a 12 or 13% interest rate loan in lieu of paying a single digit with points. And because they moved through the transaction so fast, the net result was the same cost of capital they would have gotten with a bank. And let me stress that my experienced borrowers are getting similar cost of capital to a bank because they're using our 0-point program. They're bringing less money to close. They're paying less to borrow in the end. And when you reverse it out and you look at what it would have cost, say had you paid a point to the lender or, in a lower interest rate, you quickly understand how the math gives a significant advantage to people who get it and take advantage of programs like ours. So how about the next one? Cost of capital. So let's say you got this big discounted property that you're buying. You're buying it for $100,000. It's worth $200,000 again, but you only have $50,000. Well, you got to go out and find a partner to fund the other 50, which means you could be splitting the profits 50-50. Your cost of capital for that $50,000 loan, if you will, was 50%. So if we say, Mr. First-time borrower, you're going to get a loan from us at 10, 11, 12%. That's way better than bringing in a partner who is going to want to have their hands in the renovation potentially, or how the process should go, or muck up the refinance of the property in the end. One way or the other, you're able to come in with no partner and you're able to reduce your cost of capital from potentially sharing profits 50-50, paying a fixed rate of return to a hard money lender of say 10 to 12% if you're an inexperienced borrower. And to me, that math works a lot better than bringing in a partner. So now you know that low interest rate doesn't necessarily equal best loan program. And that can mean deciding between a bank or traditional financing and going with a hard money lender, or it could mean bringing in a partner versus going with a hard money lender, or several other factors, time to close. There's so many other things that can come into play, but when focusing on interest rate, you now know that it should really be about the total cost of borrowing. It should be, how much is it costing me to go get a loan from a lender, knowing that I'm going to be in the loan for about 6 months, and then dissect it and look at the interest carry, look at how much you're paying at closing for the loan, and start to look at different ways to potentially engineer your financing to better fit your real estate investments. My name is Mike Chadwick. I thank you for watching. If you have any questions about this topic, please ask in the comments. I'm usually quick to respond. I really appreciate the support. I thank Asset-Based Lending for sponsoring the videos, and I look forward to the next one.